This is the Passive 25K podcast, a podcast built around the vision of creating wealth through passive income for ourselves and others. The idea of creating income while you sleep seems like a dream come true, but for most professionals, turning this into a reality is a different story. On this show, you will hear real people breaking passive income streams down to the basics, giving you the next steps to start your own passive income journey. If you're new to the show, my name is Kyle Reedstrom from Fargo, North Dakota, where I get to work with my team of agents and investors each day to complete our goal of $25,000 a month in passive income. Now, let's get right into our next conversation. This is the Passive 25K podcast with Kyle Reedstrom, of course, home of Passive Income University and Cash Flow Coaching. We are excited today for episode 21, Building a Niche Real Estate Fund, with John Crowell. John, thanks so much for being here, man.
Yeah, Kyle, it's a pleasure. I appreciate you inviting me on and look forward to diving into all things real estate here today.
Yes, and John, before we get started, you were just telling me, you're in Charleston, North Carolina, and you were saying it gets a little chilly for you guys as we look out the window here in North Dakota and it's snowing. What's chilly for you guys in Charleston?
Yeah, so Charleston, South Carolina. So I have less of an excuse. Yeah, even less of an excuse, right? I'm even farther south than what you mentioned there. But yeah, Charleston, South Carolina, and it's actually 5:30 p.m. Eastern here. And as you can see, I had a nice little sunlight there prior to our us jumping on this podcast. But the sun has went down, but it's less than 50 degrees, so it's ultra chilly here right now. Like, I don't even know what I got a dinner I got to go to after this. Like I might have to, bundle up with a few extra layers. It's kind of chilly here.
Your definition of winter coat and ours is a little different, but hey, we got listeners from all over the country, all over the world, hopefully. So you know what, chilly is your own definition. But John, we're excited to talk about this topic, man. And actually, before I get started, I want you to introduce yourself to the audience a little bit. Tell us about where you were, how you got to where you're at with what you're doing with your real estate fund, and explain your fund a little bit. We'd love to hear kind of a good introduction.
Yeah, absolutely. For the folks that don't know me already, I was just a normal person, just like many of you. I don't have some, crazy story to tell you about how I got into this industry per se. It's as cliche as it sounds. It really found me. I've been a business owner, an entrepreneur most of my career. And, I fell into the tech space, in SaaS. And that's actually where I still currently reside. I'm a director in a software company, but I was, running into some really good problems where, my household active income was getting up to a certain point that, the tax bills they were overbearing to a degree. Right. And I was finding I was netting out less than I would ever hope. And majority of my income was going to pay taxes. And so it was through, honestly good problems that I found, or real estate found me, because I had some really good friends and acquaintances in the Charleston market. For anyone that doesn't know, Charleston, South Carolina is a breeding ground of multifamily real estate investors. There's a ton of real estate investors, Tim Brodz, Caleb Pierce, and all these guys. They live down in Charleston. And so, I was in those ecosystems, and they're like, hey, you're I've always been good with finance and business and that kind of thing. You're good with numbers. Why don't you get into this? It'll help you mitigate taxes. And so that's where I, started to research and take it more seriously on what it could look like to invest in real estate to mitigate tax burdens. And we'll get into some of that here today and how I do that. But so in essence, it found me because of a good problem. And so in early 2020 is when I started the research phase, if you will, of getting into real estate, like commercial real estate at the propensity that I am in today. And so fast forward to December 2020, I purchased my first property, which was a 5-unit. And then fast forward to today, I have about 565 doors in my portfolio. All of it's multifamily. It resides in the Midwest, Indiana and Illinois. And I own about 55% of that portfolio, worth roughly about $43 million.
Wow. And the crazy thing people are picking up on right now is the speed in which that happened, the scalability. And that goes into how you've structured this. And I mean, I want to kick right into that with what you call your fund, how you've tied it to what you have, your expertise and real estate. I always think is a unique portion. And then how you've kind of dove into entering this space of raising funds and scaling this quickly to 43 million, you said?
Yeah, 43 million.
Man, and then and the amount of ownership you have in that portfolio is uncommon. What I've seen for huge portfolios, but a lot of people own just a sliver. You have over half, man. So let's rewind it and tell us about your fund. Yeah, even how you've named it, branded it, and grown it so quickly.
Yeah, it's a great question, actually, and something that I do enjoy talking about because, oftentimes when I first start interacting with folks that are getting into this real estate world is that, they opt into a course or get with the guru and they're just stealing playbooks in essence from these people, which is fine. You don't need to reinvent the wheel sometimes, but they don't necessarily understand the why behind the reasons why they're doing things. And so for me, I took a different approach. I wanted to understand the mechanics of all this to not only please myself, but to ensure that I instill the confidence in myself to be able to then recruit other people to come in and all these projects with me. Because it's friends, family, close acquaintances that I'm asking to participate into these deals. And so I got to understand it. It's just how my brain works. But the way that I've been able to do this is I've just been adaptable. Is probably it sounds simplistic, but that's truly what it is. And what do I mean by that? Well, I don't just have one way. I don't look at a deal in just one way. For me, it's all about trying to better understand where the seller's at, where they want to go, and how I can come alongside them to get them what they want so that I can get what I want. Right. So I am a seasoned sales professional. So I want to throw that out there. Some of these things that I'll be talking about, I've been doing for 15 plus years. And so I'm applying skill sets that I've learned in other industries and I'm applying it to the real estate space, right? I'm in software. It's very, fluent sales professionals. These are top notch talent across all industries. And so I've been able to, take those learnings and apply it to the work that I'm doing here. But by being able to better understand what the seller's trying to accomplish, it allows me to then position offers that I know are going to be favorable when the seller reviews, right? So typically what I'm doing is no different than I approach any type of sales environment is I'm trying to get in front of the sellers. And sometimes it's hard because the brokers don't necessarily want to do that all the time. But if you build some trust and you build some rapport and you help them understand the why behind it, it really can go a long way if they're open to opening that door for you. And so my first step is just getting a better understanding of the seller profile, what it is that they want to do. And so once I do that, then the key for me and my team and how we're able to scale is that, again, we're closing deals in all kinds of different ways. So we're doing it conventionally, right? Where there's been deals that I've just taken down with my own money, where I put my own money into deals and I close the deal. I've done, I've raised capital just through joint venture partnerships. So finding guys like you or close acquaintances, like, hey, I just got a little extra cash. I want to throw it into something. And we have an arrangement together. And then I have deals where I've syndicated deals. So I'm raising capital. I'm kind of the connector, if you will, maybe located deal. Sometimes it's not even that. I have someone that's located a deal. I'm just the quarterback that's putting it all the pieces and making the plays, calling the shots, right? That's called a syndication. And then I also do a lot of creative financing, which we can talk about here today as well. And I've actually secured over about $15 million of assets in creative financing where I didn't have to raise a single dime. Not only did I not have to put money into the deal, I didn't have to go raise investor capital. And in fact, in many cases, the bank has front loaded me capital at closing in excess of six figures in some cases. So meaning I've taken down a property, I retain 100% ownership, and the bank is writing me a check at closing in six-figure amount. And so that's a long-winded way of saying I've just been very flexible into how I go about acquisitions. And that's given me the fortitude to scale at the velocity that we're talking about here.
Wow. And if anybody was wondering what he meant by adaptable, I think we got a good answer on just the ways, the utility knife you've built for yourself to structure these deals. I mean, I'm just trying to think of some different rabbit holes to go down here, John, because this is, I I really want the audience to take this away. I really want the audience to hear that you don't have to have a pigeonhole you're trying to go through. What you do really need to do is learn deal flow and learn how to come alongside the seller, as you mentioned. I think that that's a universal skill across all of this. And then putting that deal together starts to shape up as you've got the deal in place. Like that structure that you've talked about kind of starts to fall into place as the deal is outlined with the seller. Is that fair to say? Or maybe you could clarify my words even more.
Yeah, 100%. It's all about the seller. And oftentimes another piece of this is the broker, right? Because brokers manage a majority of the transactions. They own most of the transactions. And so it's acknowledging that and not trying to like outskirt them or go behind them, right? And a lot of people fail to realize the importance of a broker in scaling any type of portfolio. Like off-market deals are always the hidden gem, right? We all want that. But the reality is that brokers hold the relationships in a lot of cases. And so we got to find a way to play nicely with them. Where I find most GPs or people that are acquiring, investors are acquiring assets, they fail to make sure that the broker truly feels like they're getting a good decision or a good offer as well, right? Like they have the confidence in the buyer. They know that you can close it. You're finding ways to feed their pocket more. I do strategic things all the time where I'll actually throw on a broker when I actually found the deal. I'll just throw them on and throw them a bone, if you will, because I'm doing it intentionally of trying to nurture that relationship and saying, hey, I want to make your life easier. Think of me next time you run across that next deal. And they remember that stuff. They remember how you made them feel, how you gave them a tee up once in a while. And so next thing you know, they're bringing those deals to me before anyone else and getting me first shot at it because of the way that I treated them along the way. So I try to make the broker's job simple and easy as possible, because then that means that they'll want to do more work with me and be a little biased in my offer because they know, hey, John's going to close it, going to make my life easy. I'm not going to have any problems with him. Even though this offer, I've had some cases where I've been $250,000, $300,000 less than a competing offer, but they chose mine because of the broker's ability to vouch for me as a buyer, right? But to get back on point, you have to know what it is that the seller's trying to accomplish, what their fears are, where is their uncertainty, where does that reside? Let's get to the root of those things as soon as possible so we can address them head on. The sooner we can work through that from a conversational standpoint, the sooner I'm going to have confidence from the seller that, hey, I'm working with a buyer team that I believe is going to be the right fit to close this deal. It's not always the highest price. It's about the terms and the conditions of the deal that people totally miss. They just get so focused in on the price. Price is important. Price isn't everything. And so it's understanding there's a lot of different pieces that go into a deal.
Yeah, that's huge. I know that there was a light bulb going off for people when they were saying, hey, I heard deal finding. I heard deal flow. How do we do that? How do we do that? And you touched on it, befriending the brokers. These brokers are huge keyholes to many, many deals, many pipelines of deals, future deals. And I liked adding a little spiff, creating that relationship. Once there's trust there, why would they not go? I mean, from my seat as a broker in many different transactions, I know for a fact we lean towards buyers we trust, buyers that have shown trustworthiness in the past. So I think that that's huge, and especially for deal flow. That was a really great point. And, I want to go to a place where a lot of this has, it goes down the road of scale. It goes down the road of quantity. And I like to back it up. I like to say, John, you started somewhere, right? You said you kind of started taking in 2020, not that long ago. You had taken down your first 5-unit. Walk us through a little bit of like how those initial dominoes fell for you. Maybe talk through that 5-unit purchase, then maybe your next one, how it kind of started to fold on top of itself, if you would.
Yeah, and I wish I was that smart, overly smart individual that just everything clicked. Unfortunately, that's not me. And I have a lot of tenured from a business perspective and a finance perspective that I brought with me to the point to where I transitioned into real estate. I think it's really important. I say that not to discredit what I've accomplished, but for people to understand that I just didn't wake up one morning and say, okay, I'm going to buy real estate and all this stuff started to work out. I'm carrying business lessons, lifelong lessons, finance background with me that I just aligned within the real estate industry, specifically sales experience, things of that nature. So I do have skill sets that everyone's going to have, or that they've built up to this point. And so I don't think that we should discredit that. And I think that's really important for people to understand. So I did have a little bit of a competitive advantage in that sense, because I'm in a software industry where, I work for a company. We just got acquired for $1 billion. And so, I have we run millions of dollars, 50 million plus in the division that I oversee. And so I'm used to looking at P&Ls and all those types of things that translate into the real estate industry. It's just a little bit different terminology is all, right? So, but walking back into the first deal, I think the biggest thing is there really wasn't anything special about it, to be completely honest with you. I thinking back, I started, Bigger Pockets, all these different podcasts, and started consuming books. But really what happened is I just started reaching out to my network and saying, hey guys, I'm interested in purchasing some commercial real estate, specifically multifamily. If anyone knows of anything, let me know, kind of thing. Well, it was through a good friend of mine that I grew up with, that he's like, hey, he does financial planning. He was like, hey, I have a client that has a multifamily building. I think he may be interested in selling. It's not on the market or anything. I just think he'd be open to it. Well, we were driving down the road. I was visiting back at home in my hometown of Terre Haute, Indiana. And I was like, well, drive me by it. Let me take a look at it. So we did. And I was like, can you call him and see if he'll, come by and we can talk about it? Well, he was like, yeah, I can meet you tomorrow, whatever. So we met up, walked the property. I got some high level financial information from him. And I took the information and did a simple calculation to say, okay, well, I think I could pay this, based on what I know. And he's like, yeah, I mean, it's a little lower than I was hoping, but long story short, we did a little negotiation. Next thing you know, we shook hands and that the deal went under contract essentially, right? And we had to get a lawyer involved and write the contract up. But point being, it was a handshake. It was we had an agreement, and so that's how it all transpired. It was actually a hybrid deal between, it was actually a seller finance deal, but I did put money down. So I put some of my own capital into the deal. I put 10% down, and then the seller financed it interest only at a 3% interest rate for 3 years. And so I'm actually coming up on my first turn on that property where I'm going to actually refi out. Unfortunately, rates have went up a little bit, but the value's also increased by about $150,000. So on a $300,000 asset, so now it's worth about $450-ish. So I have plenty of equity. Unfortunately, the rates are a little bit higher than I would hope, but I'm cash flowing heavy off of it, and I can absorb that higher interest rate. And hopefully, in the next 4 or 5 years, rates will go back down, and I'll refi it again and get a better cash flow projection than what I'm going to be having with these higher interest rates.
John, I liked how you set that up, initially saying that you had to use some of your skills from your current, your current expertise in sales and in software. And I think everybody can look at what they do currently, look at the skill set they've built up, even if you're really early in the game. I'm talking to people that are in their early 20s in thinking about this stuff and listening to this stuff and consuming this stuff. There are skills that you've acquired that are going to transfer, that can be transferred into real estate. Real estate's one of those things that can be a catch-all and find your expertise and apply it the right way. Just like John had said, if you apply it the right way, it can be your competitive advantage. And I also really keyed in on one thing you said. Once you had some clarity that you wanted to do this, you talked about it. You told people about it. And guess what showed up? There was a 5 unit that got put in your path. And I think it's so key to state our goals. I know in our world, we've started to talk more about what we're doing and what our goals are. And it's really been crazy to see the attraction and the things that have shown up because of it. And then, man, you structured a seller financing deal on your first deal. I'm just loving this. So that gave you a taste, man. Keep going. I don't want to stop you. What happened after you got this deal struck and you're now a real estate investor?
Yeah, it started to cascade pretty quickly. I'm a type of individual, like once I get my footing with something, and then I'll pour gasoline on it, I'll just double down. And for me, I think the biggest thing to note there is I don't do the paralysis by analysis. I know I'm never going to nothing's ever perfect. Right. And I think that's where most people just fail is they just never get into a deal. They're looking for the home run, right? And those are just so far in between. They're just, no one ever really, it very rarely do you come across that, especially in the environment that we've been up against. And so for me, it's all about less about perfection and just more about getting in the game, right? Getting the single, the double. I just need to get in the game. And so that's what I focus on. That's what that property is. It's a double, a triple, if you will. I'm getting consistent cash flow. It's making money, but it's not a home run. Like I'm not going to, retire overnight over that deal, right? But I got into the game. Well, next thing you know, just because I got in the game, got my footing, and I was like, all right, I'm going to go do this again. And so then I, found a 8-unit deal, and then I actually ended up buying a triplex, and then that kind of sums up my smaller unit portfolio. And then the next one went into I purchased 24 units, 18 units, 25 units, recently 128, 110. You can see how that starts to go up pretty quickly. Now I'm at a point to where I don't entertain anything that doesn't gross at least $250,000 of gross income per year, which in the markets that I play in is roughly about 20 to 25 units at the bare minimum. So that's kind of where from a buy box perspective, I'm at a point where I won't even evaluate anything unless it brings in 200 or $250,000 a year.
So talk to me about that a little bit, John. I'm hearing a criteria. I'm hearing you've adjusted your parameters and you've kind of, hey, I'm not even considering this. Has that been a big thing for you, is like knowing exactly what you're searching for? Or has it been more of a cast a net and look for stuff? Or how have you kind of honed in on your specific things you want?
Yeah, so I spent a lot of time over the last few quarters better understanding my business plan moving forward, because one of the challenges you don't hear a lot of people talk about is actually the scaling aspect of this business. It's actually can be very challenging, and it could be a major problem if you don't start to input good systems and processes as you start to bring on that level of door count, right? And so I live in Charleston, South Carolina, and have all my real estate portfolio 12 hours away. And so you have to have really good systems and processes and people to be able to manage all this stuff, because especially for a guy like me that's living on the coastal market, but my portfolio is across the country, right? And so in order for me to go, for me in 2023, my goal is to get to $100 million by the end of 2023. In order to go from where I'm at today to where I want to go, it's going to require new skill sets, new ways of going about our business that looks much different than what we use and how we did it to get to where we are today, right? And so I'm investing into personnel. I hired a director of operations. We have a bookkeeper now. I'm going to be hiring a CFO at some point. Like I'm investing into the future of this business. And so, as you start to scale, you have to dial in your systems. Otherwise, it's really going to become a problem. And I think a lot of people don't really highlight how critical the operational side of this really is. It is crucial to having a successful portfolio. You have to have the operations dialed in. Too many operators that I've run up against that don't know their KPIs. They don't have the right systems in place. It's super sloppy. And you see that in their performance. You see that in their inability to meet those projections that they had forecasted, unfortunately. And so those are things that we're trying to prevent from happening here, and something that I do take pride in improving as we move forward.
That is such a key, man. I always say that investors, especially real estate investors, think they're an investor just because they own a property. And I really feel like you're a skilled investor once you have mastered operations. Just like you said, you can have a huge portfolio that doesn't make any money. In fact, we've seen it all the time that when people come to us to sell property, how much little our margins are, how much money it's not making. And I see so many investors find properties that are not making money, and they put their investor hat on because they want to wear that operations hat. They want to hone in on some of these systems you're talking about, and they can drastically change the picture of a portfolio or a property. And that's what you're talking about here, right, John?
Yeah, I mean, the difference is in the details, right? So, there's not hefty margins on real estate if you're playing the long game, right? Like an extra 5 or 10% could be what you consume at the end of the year, So like, it matters so much into the performance of these properties, these assets, and how you manage them matters so much in terms of what you actually net at the end of the day. But also preventing things from spiraling out of control. I think we're going to see a big block of assets that are going to come to market because unfortunately the entry, the cost of entry is actually relatively low in this industry relative to the output that can be created. And I think there's been a lot of people, unfortunately, that have gotten into this business when times were great, everything was going great. But now with interest rates and inflation, the macroeconomic conditions that we're all experiencing, it's going to be really telling to see who's great and who's not during the dark times. And I think that unfortunately, we're going to see a lot of people, lose their tails because they got into something without really having the knowledge, the intellect to be able to run that type of asset. And I hope, because I don't wish ill intent on anyone, but I hope that doesn't happen. But my gut is telling me that we're going to see a lot of deals resurface due to lack of performance, due to the inability to refi because they're not going to meet the debt service coverage ratios with the rising. There's just going to be a lot of things that are going to happen, I think, over the next 2 to 3 years. But here's here's always a silver lining. For the folks that are really taking this seriously and are getting it, up to speed and are partnered with the right people like myself, I'm going to capitalize, right? So I'm more confident than I've ever been that over the next 2 to 4 years, it will be transformational as it pertains to generational wealth that I'll create for my family. I mean, I've already done that, but I'm about to amplify that because I'm basically getting my troops in order to just pounce on opportunities when they come up. And there's always deals in every market, no matter the season, no matter the economic conditions. There's always going to be deals to be grabbed. Are you well positioned and do you have the resources to take it down? And that's kind of what my team's working on right now. We're gearing up for what we believe to be one of the best buying opportunities for us over the next couple of years than what we'll probably see for the next decade or two.
Wow, that's a great place for us to take a little break. I love that little forecast you just gave. It's excitable. I mean, that was exciting to hear how you're preparing, and exciting for you to kind of pass that along as like, hey, if you've got your sword ready here, it's going to be time to make hay, So we're going to take a little break. When we come back, John, I want to jump into some of the syndication work and raising funds and kind of how you've taken people that want to get into this, raise some money, and then been kind of that general partner like you speak. So we'll take a break and we'll be right back.
Sounds great.
Hey, wanted to take a quick break from this week's episode. Wondering if you ever ask yourself, how do I get started in this stuff? Or if I'm already doing it, what are some next steps or people that are doing the same thing that I want to do, people on this passive income journey? Well, we were getting that question and we created a community of passive income investors called Passive Income University. This is a place where you can watch videos, things that we've done, where we put tools and information, where we've built a community of people that can communicate, ask questions, and grow together to start their passive income journey. And eventually we complete our passive income journey together. If you're interested in more info on Passive Income University, check us out at p25kg.com. Okay, we are back with the Passive 25K podcast with Kyle Reedstrom. It is episode 21. We're talking to John Crowell. And John, you had talked to us about the market, what you're seeing coming up in the market. You talked to us about how you've structured some of your initial deals. And you said you've used syndication as a tool for building your 565 unit portfolio, your multifamily portfolio. And I think syndication has been a thing we've heard more and more about in our world, people asking that question, how does it work? What are the ingredients of a good syndication? If someone's just checking this out, or even maybe has people saying, hey, I've got some money, are you putting a fund together? Are you putting a syndication together? And then someone's in the space where they have the ability to do it. What advice, or like I say, what are the simple ingredients to get something like that executed?
Yeah, it's a great question and something I often get from my audience as well. So I'm happy to tap into this because I think it is a hot topic with where we're at with things. So, analogy that I often use when we're talking about syndications is it's no different than like building a house. right? You have a general contractor, if you will, that's quarterbacking or, working with all the special tradesmen on building the house. The general contractor isn't the one that's actually, putting the drywall up and laying down the finishings and painting the walls and all of that. They're just coordinating everything is essentially what they're doing, right? Now, sometimes contractors will act as subs and they'll play some part of a specialty at times, but for the most part, what they're doing is they're just making sure they understand the vision. They understand where the homeowner, how they envision the house and how they want it to look, and their job is to make sure everything goes as planned. And so that's in essence what a syndicator does in simplistic terms, right? They are the contractor as it pertains to the asset in discussion, which is in this case is the real estate, right? And so they're bringing in subs like property management, capital raising teams, due diligence, boots on the ground. So they're in essence, quarterbacking or coordinating all these different subs, if you will, into bringing a deal to fruition, and so that the deal could happen. And so that's what we do in the syndication world. Is I act as a general partner, which basically means that I'm the head honcho. I'm in charge of making sure that things go as planned. And so I like to break syndication up into 3 to 4 primary roles. So one of those happens to be locating the deal. So who is the person that found the deals? That's one critical piece of the puzzle. You got to have a deal in order to take it down, right? So that's one piece. Another piece is kind of due diligence, post-acquisition work as it pertains to boots on the ground. Who's going to physically walk this property? Who's going to be doing that on a frequent basis? Who's going to make sure that we have to do any capital improvements, things of that nature? Who's going to be the person making sure that stuff gets done, right? And then we have, I'd often refer as the third aspect would be the capital raising. Huge component of all this, especially if you're talking about millions and millions of dollars. The last 2 properties that I closed was worth combined was about $13 million of real estate. It takes money to be able to close that level of volume, right? And so it requires capital raising. And so some people they're called a capital raiser. Their whole job is to help bring in capital to the project, and so that we can acquire it and perform all the improvements that we want to increase value, et cetera. And then probably the most critical component, which oftentimes is owned by the syndicator themselves, is the asset management. So once the asset has been acquired, who's going to make sure that we're having the property management calls weekly? We're making sure that we're driving towards the KPIs, the goals, the performance metrics that we put out. Those are kind of the 4 main roles of a syndication. So we have, the deal hunter, the person that located the deal. We have boots on the ground. We have capital raising. We have asset management. You got 4 major parts of a deal, right? And so how you slice and dice that cake up or that pie up really it varies. It depends on the relationships. It depends on the ROIs that are in question. It depends on the deal structure. There's just a lot of nuances that go into it. So I won't go into too many details there because I could talk about that stuff for days and bore your audience. But one thing I do want to touch on here that I think is really important for your audience to understand is I find, and I referred to this earlier in the podcast, too many people go into this with a blanketed approach without understanding the why behind why it is that they're doing or suggesting a certain structure. I see this all the time. And it's questions you'll see in communities. What should be my split? What should the split arrangement be? Well, that's hard to say. I mean, it depends on your return on your investment. It depends on the roles. It depends on the responsibilities. And so where I've been able to, I think, also retain more equity is because I actually understand the why behind it, right? I'm not just saying, okay, well, this guru told me that I should do a 70-30 or 80-20 or 60-40, right? I didn't do that. I tried to understand why it is that we would do it that way. And what I uncovered is most of the times people didn't have a good answer to that question. They didn't know themselves. I've talked to gurus, if you will, that I'm like, hey, why did you structure that deal that way? Well, that's just the way that we do it. But why? Why did you choose that structure? And so for me, I take a more of an analytical approach to my deals. And so what I'm really trying to accomplish is, my investor base, mostly in technology, business owners, these are savvy individuals that are extremely busy. They do not want to play an active role at all in this project. They just want to be a passive investor. They have a certain level of expectation for the type of return that they expect on the dollar amounts that they're injecting in my deals. Typically, minimum is usually $100,000. I've had people throwing $500,000 into my deals. And so, for them, it's all about risk and reward and what their involvement is. And so typically I'm getting my investors, anywhere from a 10 to 15% cash on cash, total return, 20 to 30%. If I can do that where they just get mailbox money, they're tickled. And so that means me giving up 10% of equity for that raise, or 20, or in some cases 5. It's really less dependent upon the equity percentage. I mean, equity does matter, but it's more specifically, what is the ROI? What is the return on their investment for, investing in that project? And I think something that often isn't talked about enough, because people don't want to have these tough conversations, is anyone could put numbers on a pitch deck, right? Anyone can say, hey, I'm going to go get you 30%, but can you deliver that? Can you deliver the returns that you're projecting? And so, I look at these pitch decks all the time, and people are very unrealistic with their pro formas, calling double-digit year-over-year growth, low vacancy, expense ratios are really low, undercalled. So yeah, you're offering some crazy numbers because your projections are too light, right? So for me, it's all about. An investor told me this once. It's the biggest check I've ever gotten from an investor. Didn't even look at the pitch deck. He said, John, I'm betting on the jockey. I don't need to see the pitch deck. And so you have to understand that this is a relationship business, especially when you're raising capital. A lot of times it's more about, do they trust you and your capabilities to deliver? Are you going to back up your words? That makes the difference ultimately, versus some guy that's really good in PowerPoint or Excel or whatever and making a fancy projection, trying to sell people on that.
That is so unbelievably full of excitement, confidence, and pressure, man. When he says, I'm betting on the jockey, and you're like, oh, wait, I better make sure I'm doing what I say here. I think that's a huge piece of this for people that are, hey, I've done this before. I hit this returns for my own place, and I can show some of this, but it still doesn't give you ultimate confidence to go in and replicate it, because every deal is unique, right? Did you take that as like, oh my gosh, I got to make sure to put my money where my mouth is here? How did you take that? Or were you just very, very confident in some of these deals that you can't predict the future though, right, John?
Yeah, I mean, here's the deal. I think, savvy investors understand that things aren't always going to be rainbows and butterflies, right? Like, it's not always going to be happy days. And so for me, it's also being able to have those tough conversations around, sometimes our timelines are a little stretched, or, things don't always go as planned. We're going to get it there. Maybe there's just things that happen. And so what they're really saying is, hey, I understand that things aren't going to always go as planned, but I think you've been very conservative in your outlook here. So like, yeah, you may get some puts and some takes, right? But overall, I just want to make sure that we're winning. And more importantly, a guy that's worth 100 billion, not have 100 billion on his assets and on his balance sheet, but he's worth 100 billion, told me this. He said, most rich people are focused on return on capital. Wealthy people are focused more on return of capital, meaning security. Like, hey, things may happen, but I'm not losing my money, right? Like, so maybe I don't quite hit the pro forma, but I've yet not to deliver. But the point being is that I'm doing all I can, and they know, my investors know, that I'm gonna do everything in my power to protect their money, protect the asset, and do what's right by not only my investor but myself and my partners. And sometimes that means being able to address, not so great conversations of like, hey, we had this happen. I mean, I could go on for days of things that didn't go as planned, right? But we worked through it. We had a solution. It's all about solving for problems, right? So for me, I'm very confident in my problem solving abilities. So even if I do have problems, which I know I'm going to have, my ability to get through those and solve for them, I am very confident in that. And so sometimes that means our timeline shift a little bit, but I'm very confident in my abilities to deliver for my investors.
Man, John, we're heating up here, man. Return of capital versus return on capital. Man,
Yeah.
that is awesome. And return of capital, of course, being once you have all your money back in a deal, you don't have any risk left. I mean, that's the complete de-risking tactic, is to get your money back. Um, Man, I want to go back to your why point, because that really hit me. Hey, how do these deals get structured? I find myself asking that. How did you structure that syndication? Or how did you structure this fund that you started? And it's a 70-30 or a 80-20. And when you ask the question why, to your point, it's just because that's what I've seen. You know, that is not a good answer. It was very convicting, because honestly, I've done this before. We've raised money. We've had a fund, and it's like, well, it's just what we've seen other people do. But why? And what you touched on, and if you're willing to share, John, what is the reason why for you, and how have you structured the equity on these? Because you've shared this with me a little bit, and I think it's very much a tie to the question, to the reason why. Go ahead. I'd love for you to share on like how you've kind of structured yours and why.
Yeah. So again, every deal is a little bit different. I mean, I don't know if I've taken a deal down or replicated the exact way I've done every deal, to be honest. They're all different. But what I look at is I'm really looking at the value that I'm creating. And typically for investors, if you're involving investors, it's an ROI, right? It's what they're going to get in terms of return. And so what is your investor base's expectations, right? So we're living in a world where, 6 months ago, even 6 months ago, everyone was winning everywhere. Stock market was through the roof. Real estate was happening. Everything was hunky dory. It was great. And you were seeing these high pref commitments of 12, 15. I'm like, you guys are crazy. That's times are good right now, but what if things don't? What if things aren't that great? And here we are, where things aren't that great, right? And so what I've done is I've avoided falling into the trap of overcommitting and under delivering. And so it's going back to the sales approach, understanding what is it that the investor is seeking out. Are they seeking steady cash flow? Are they in a point in their life where they want more volatility? Do they want to take on? Do they want to assume more risk? Do they want more guarantee? And so I have some investors that have given me money without any equity at all. They're just like, hey, I just want a fixed amount. I'm like, great. Well, in order for me to guarantee you something, that means I'm going to take on more risk. And so with that, I got to take these things off the table, off the plate, right? Which means maybe it's equity, maybe it's other pieces. But for me, it's meeting them where they're at, but also helping them understand, the why behind what I'm suggesting to them. If it's payout amounts or percentages or what have you, I'm helping them understand what they should expect from me. And sometimes that's even been the case of, I've had people say, well, look, I could go over here and get a better split, more equity. I said, then why don't you do that? Right. And so sometimes you got to be willing to let them go, because maybe it just doesn't fit or align with you and your investment strategy. Not everyone's going to be a marriage. Right. And so I treat, I want to work with many people that I can, but trust me when I say you don't want everyone to be your investor. Right. For me, I don't even entertain less than 50 grand because you're not ready to step into this deal. My investors, I never hear from them. We have to send them communications. It's not their last dollar, right? So these things aren't like, and I like it that way, not because I don't want to communicate with them, because I love them. A lot of them are friends and close acquaintances, whatever. But it's the way that I like to operate. I like to be able to say, hey, you trust me, I trust you, give me some autonomy. Whereas if you got someone that put their last dollar into a deal, they're calling you up every day like, hey, what's going on with this? Like, where are we at? And it applies additional pressure, unneeded pressure, and things of that nature. So I think what I'm trying to relay here, and sorry, I've been a long day, but is you're not looking to make everyone an investor, nor are you trying to make everyone a partner. You need to figure out what is your strategy, what is your approach, what is the package that you're offering, and find people that want to play within that sandbox. It's really that simple. I just think people get desperate, and so they take things that they don't normally want to. They take things they normally wouldn't just so they can get something done, and that stuff's going to come back to bite them, unfortunately. Whereas I've stayed tried and true, if you will, to saying, "Hey, I'm flexible. I'm adaptable up to a certain point, and then if I feel like there's not a fair, equitable give and take happening between investors or a partner or a seller, then I'm backing away from it because it's not worth, for me, it's not worth going into that marriage ultimately, because that's what we're doing. It's not worth going into that knowing that, hey, it's going to blow up probably in a short period of time because I just tried to force something.
Yeah. And, John, I'm hearing your themes of getting to know your seller come back to getting to know your investor the same way and understanding what their goals are, what their why is, because I'm hearing stuff like if they need higher guarantees, which is less risk for them, it's going to equal lower equity because you need to pull some of those spiffs, if you will, away from that, the benefit package if they're going to have a higher guarantee. If they want higher equity or they want more of that long-term thinking, it might be more of a preferred return rather than a guaranteed. Are these the knobs you're talking about turning with different investors as you get to know their reason why?
Yeah. So not to get in, I'm not your legal attorney. I'm not your CPA. I want to throw those disclaimers out there, but, understanding your investor base before you start to approach them is really important. So for me, like, I won't even consider taking someone's money unless I've had an introductory call, gotten to know them, built a relationship, etc. I'm not just throwing my pitch decks out to everyone. I also segment my investor base based on their needs, their desires, their wants. And so I have folks that are just, no, I'm going to be like a promissory lender. Like, I want to give you money, be tied to the asset, no equity, just want a fixed, percentage back on my money. Those are typically short-term players. They're looking to deploy capital for a couple of years to 3 years. And sometimes those relationships make sense for the projects that we're on or just, what we're doing. But then I have people typically when I'm doing from a syndication standpoint, if it's truly a syndicator where I'm bringing in investors, getting some equity, whatever, my people, I just tell them like, hey, my goal is to under promise, over deliver. So a lot of the timelines that I projected have been 5-7 years in some cases. Like, hey, we could do this in 2, but we don't know what the interest rates are going to be. You know what I mean? So like, I don't want to paint that picture that we're going to come in here and do this in 2 years when we in fact we're going to need 5 to do it. And so I'm trying to bucket these investors based on their risk profile, based on their preferences, based on their expectations. And so I can almost marry them to the deal I think best fits them, as an investor. Because not every investor is going to be right for every deal. You got to understand, going back to understanding, you got to understand the deal, and you got to also understand the capital, the investors that you're working with, so you can marry them together at some point down the road.
Yeah, and you touched on the four pieces of the puzzle. The deal finder, due diligence, capital, raising capital, and then the asset management. Early in doing this, John, did you have to wear a lot of those hats, or was that something that you just knew, like, I am not going to be doing asset management. I need to find the right partner, or I'm not doing it at all. Or is this something that you kind of dabbled in and then leveraged and built a team after?
Yeah. So typical, roll your sleeves up kind of situation here. I was wearing all the hats, and I still do in a lot of cases, right? But what I have done that I think is very strategic, I have a general partner. We don't actually have a formal partnership, if you will, but we do tons of deals together. What I've gotten better at in general in life is understanding more of the things that I do not want to do. Right. Mm-hmm. So through those trial and tribulations, through those life lessons, I've uncovered things that I'm just not passionate about, I'm not good at, or, whatever. And I'm trying to avoid doing the things that, just really don't bring me energy and fulfillment. And so one of those happens to be the boots on the ground. I'm a transient person. I'm in tech. I need my laptop, and essentially I can do my job anywhere. And so I've extended that environment into the work that I do here in real estate. And so I have a partner that I strategically partnered with. He resides in Indiana, Mike Hochschletter, just a little shout out to him. Great guy, very seasoned business owner. He runs an 8-figure utility contracting company aside to his real estate portfolio with me. But we have a great team together. He is local to the area. He acts more as boots on the ground. He also has a construction background, so all that boots on the ground stuff, it's his world, and he understands it better than I do. So I've gotten very strategic about my relationships and being able to leverage people in their skill sets, right? So I'm good at numbers. Like I'm the nerd behind the scenes in the Excel sheets, like I nerd out about that stuff. I'm also really good about organizational management, SOPs and scaling things. Like that's what I'm good at. And so I try to just focus in on that. Like, hey, let me do what I'm good at. And then I'll let these other people do what they're good at. And so I really play more of the asset management, specifically on their operational side. I've raised about $6 million in private equity over the last 18 months from my network. And I don't even consider myself great at capital raising, to be honest with you, but I've been able to do it. And so, and I do boots on the ground. I'll travel, I'll fly in and I'll look at properties. I do think it's helpful to get your eyes on a property, right? But what I'm getting at is I'm willing to do whatever it takes to get the job done. But as we start to scale, we're starting to specialize, if you will, on these roles and responsibilities. So I'm investing in the future $100 million portfolio today. So when I get there, I can actually manage it, right? So there's investments happening as we speak into this business. I'm investing into the business to prepare us to be ready for the $100 million portfolio before we actually get there.
Yes. Yeah. And I think people that are thinking about getting this going and are being, finding themselves in overwhelm or analysis paralysis is understanding the seats on the bus and then understanding which ones you're really drawn to or which ones you're really, really good at, and being honest with yourself on what, like John said, what you're not interested in or what you're not good at. I think some of the rub that people feel is when you're sitting in one of those seats that you're not necessarily good at. And then that's kind of a recipe for forcing capital raise or forcing the numbers to work if that's not your jam, So I think constructing your team around this stuff, if you're thinking about getting into this, can be a crucial part. And yes, you're going to have those roll up the sleeves moments, but man, if you can find the yin to your yang on some of these things, if you can find your weakness and find somebody where that's their strength, that can be such a crucial component of success. Like you said, your due diligence partner, man, that has probably been a huge strategic partnership for the reason why you guys have been able to make these perform, in my mind. So,
well, I think it goes back to lifestyle too. Like, what kind of lifestyle you want to live, right? Like, yeah, I could jump on a plane and fly back to Indiana every week, but do I want to do that? No,
yeah,
no, I really don't. Right. So like, money's great. I want to make a ton of it. Don't get me wrong. We've made a lot of money this year, but, fulfillment, energy, family, time. I don't want to trade one active gig for another. Right. I'm trying to create a lifestyle of design. And for me, it's like, okay, we're dealing with a huge watermelon here. So we can slice and dice it. There's plenty to go around here, right? So
yes,
I think it's just more of an abundance mindset that you have to have. You really have to have it in order to scale at the propensity that we're talking about here. You're purchasing hundreds of millions of dollars in real estate. You have to have a team. You can't do that by yourself. So it's understanding that. Now you may say, hey, no, I don't want a big team and I don't want a $200 million portfolio. Oh, cool. You can own it. I know some guys that own 100 doors that own it clean and clear. They don't owe the bank any money. They don't have any partners, and they do well. My neighbor owns a mobile home park portfolio out of Charleston, and he's like 40 grand a month, I believe he nets. You would never know it, So it's just what are you looking for? You know what I mean? The kind of thing is what you got to figure out.
Man. John, I've really enjoyed this conversation, man. I think you've shed light on so many aspects of how of starting this, where you came from, growing to a larger portfolio, where you want to go. You've shared that with us. I love that, and so many tactical little nuances you've shared. So thank you so much. For people that are curious, man, for people that want to connect with you, how can they find you if they're in our audience listening and they're drawn to what you're saying?
Yeah, so we didn't talk much about it, but I am spinning up a new community that's called SAASY, SAASY, Real Estate Investors. And what that acronym stands for is Software as a Service. So we're really hyper-focused in on software and technology people. We're connecting the dots between real estate and SaaS professionals, essentially. So the majority of my investor base, people that we're working with, are in that community. But so we found that you can go to SAASY, SAASYREinvestors.com. Check us out there. I'm very active on LinkedIn. So for anyone that wants to touch base with me, I recommend getting on there. John Crowell, Crowell, Instagram, Facebook. You can find me in any of those. So don't be afraid to reach out. Happy to help in any way that I can. And just look forward to, hopefully we'll get a part 2 of this. I feel like we didn't even, quite scratch the surface of what we could talk about here today.
Yeah, I feel the same way, man. And it's been a joy to get a view into your world and your build. And it's going to be fun to get an update when you're crossing that $100 million finish line. So, and probably just getting started from there, man. So, John, thanks so much again for the time. Really appreciated the time that I've gotten to spend with you, to get to know you. It's been awesome that you got to join us on the podcast here. And again, looking forward to the next time. Thanks, buddy.
Yeah, thank you.
This has been the Passive 25K podcast. If you enjoyed today's episode, be sure to subscribe so you don't miss future conversations. Also, tell us what you thought by leaving a comment below on today's topic. If something really hit with you, don't be afraid to share this with someone else that's interested in passive income. Thanks again for tuning in. I'll catch you next time for another episode of the Passive 25K podcast.